Hey traders, Todd here of TradingAnalysis.com and Inside Edge Capital Management. This is a free video update. This is going to be Wednesday the 25th. Market's going crazy. Also, sorry to be quiet the last couple of weeks. Haven't done any marketing, barely on Twitter. I'm just heads down focused on the membership, the trading analysis, and the money management business. It's all markets. It's not marketing, right? It's the kind of market we're in. So, sorry, but not sorry. Anyways, let's go. I'll get you updated where we are from my point of view, and kind of share some three key things I think to kind of shed light on. I think what's going on in the markets, what's causing the volatility, where we may bottom if we bottom, and some of the indicators that are showing us at the bottom. So there's three things that I have planned for you. To start, let's look at the sector and market capitalization, rotation, also within growth value. So when we look at the RRGs, show you what's going on there. Number two, I want to look at the internals underneath the index level, show you some of the inner workings of the indexes, show you what's going on. Number three, I'll show you the technical position of the indexes and where I think we are. So we have a lot to do. Let's jump in. And again, hope you guys are well. Hope you're okay in this crazy, crazy market. So let's roll. Okay, so from a rotation point of view, so this is monthly RRG benchmark to the S&P. And what we're doing is looking at mega cap growth and mega cap value. This is the monthly, okay? And what happened was mega cap growth, your MGK ETF rotated in August, September, and here we are in October into monthly leading. That is significant. That means Vanguard's mega cap growth stocks, as we are now in earnings season, are showing better relative momentum and relative strength to your benchmark S&P compared to mega cap value stocks. So we are in a position where growth, large cap growth stocks are showing better relative strength and momentum to value. Okay. Now this is monthly and this is the weekly. This is even better. Okay. So obviously 4 of these dots is 4 weeks. That would make up one of these dots, which is a month, right? And what's happened here on the weekly is pretty much right here at the end of, right in the middle of September to the end, we started to get a very nice hook up. So in the last month, mega cap growth has hooked up in weakening and is headed towards weekly leading, as value has also hooked down in September on the way down. So you have monthly growth well in charge, and you have the weekly, which was trying to rotate out, slowing this move in the monthly, all of a sudden reverse and head straight north. So now you have weekly confirming what's going on in monthly. That means we are showing relative strength and mega cap growth. Markets are selling off, but mega cap growth is showing better relative strength and momentum to the benchmarks as the markets are selling off. So if the index is final low, these are the stocks you're going to be looking for to lead you out. Okay. Now, if we look at the sectors, same thing, monthly up top, weekly on the right. All right. First thing you're going to notice here is all of these guys to the left. Everybody in the Western hemisphere here are underperforming the benchmark, which is the S&P. So that's financials, industrials, healthcare, staples. Sorry, I'm going to do this again. Financials, industrials, healthcare, materials, staples, real estate, and utilities. All of those guys are to the left, which means lesser relative strength and relative momentum to the benchmark. On the right side are consumer discretionary, technology, communications, and energy. Okay, energy has begun to rotate down as crude just got denied from 90, right? On the monthly, though, even more important, everybody who's on the left on a bigger time frame is underperforming. Everybody who's on the right is outperforming. What's outperforming? Tech and comms. Beautiful monthly trajectory there, right? And XLY has been underperforming, but is beginning to catch up. Now, if we could get XLY, which is right here, to start to turn up, and of course we have Amazon earnings coming up, that would be a big help. Tesla's been under pressure, as we know. But if we could get XLY to push up there, that would kind of complete the growth trifecta and confirm that the growth trade is very much in play, right? Everything else, what's happening? Energy's rotating out. Industrials rotating out. Materials, health, staples, financials, utes, and real estate all rotating out. So we are in a growth trade led market, except it's very interest rate driven, right? It's all about that 10-year yield. All right. So let's look at the internals. Okay. I'm going to hit you quick on the internals. Let's start with the tick. All right. So let's look at the NYSE tick on the, let's actually go to a 60-minute chart. Okay. So in magenta is the S&P, and down here is the NYSE tick, which is basically measuring the amount of upticking stocks versus downticking stocks that minute on the New York Stock Exchange. Anything below 700 or so indicates 700 more downticking stocks and upticking stocks, which indicates institutional sell programs. On the upside, when it's plus 600, plus 700, those are institutional buy programs when they just come in and buy a bunch of stocks, right? So it indicates institutional activity. Well, I put a moving average over there to smooth it out. It's like a 10-period moving average. And what you'll notice here is as the S&P is making a lower low, the tick is not making a lower low. In fact, we're significantly off the high. In fact, the tick made a low. The moving average made a low back here on, looking at this day right here, on the 19th of October, yet the S&P continues to go. So institutional sell pressure is easing here. And this most recent push down, again, we're not really getting a lot of institutional sell programs to push the moving average down. Okay, so that's tick. Let's look at advanced decline. All right, same thing. I'm going to smooth this guy out. Let's go to a 60-minute. Let's see what we can find here. Advanced decline. All right, S&P and magenta, again, making a lower low. I'll just throw a little trend line in there to highlight it. So a little lower low there. And what's advanced decline doing? Of course, making, let's see if I can do this quickly. What's advanced decline doing? Making consecutive higher lows. So you're not getting the breadth of more down-ticking stocks on, more declining stocks and advancing stocks. So you're getting divergence there. Indexes are lower, except advanced decline on the 60-minute is diverging higher. That's advanced decline. How about VIX? Volatility. All right, what's going on here? VIX and S&P. I'll just make that purple real quick. Okay, so S&P making a lower low, and the VIX right here is making a lower high. So not so much here. This one's confirming, but just over the last, from the 23rd, which was 2 days ago, we are not getting a new high in the volatility index as the S&P is making a lower low. So at the money puts and calls, the volatility and at the money puts and calls not juicy enough to push VIX to a new high. Again, not a lot of fear at the money in those options. So looking out of the money, looking at like 1 and 2 standard deviations out, which is essentially what the vol skew is. VIX looks at near-term options. Vol skew looks at out of, further away from the current market. We should be making a new low here in the vol skew. Not happening. S&P making a new low. Vol skew not making a new low. So we have tick, we have advanced decline, we have VIX, we have skew. How about put to call? Same deal. Put to call made a high here back on October 5th, and S&P making a low. The moving average is not at highs, and you can even see the put to call ratio is not spiking up around 1.2, 1.3. All we can get is like 1, right? So you're not getting confirmation from put to call ratio. What else we got? Put to call, skew we did. That pretty much hits all of them. How about trend? Okay, basically advancing volume and volume and advancing shares compared to volume and declining shares. All right, let's go out to like a 60-minute here. You're going to see the same thing. You're going to see the exact same thing. As the S&P is making a low, trend should be up here, and it's not. It's making consecutive lower highs. This guy trades opposite to the S&P. So you have across all the internals non-confirmation of a move lower. Now let's finally finish it up, and let's get inside the market. And here you go. Actually, I'm gonna string it out one more second here. Okay, we're looking at the 10-year yield over the Nasdaq. And what I've done is I've taken the 10-year yield and I've flipped it upside down. 10-year yield went up to 5. We've backed off, and now we're trying to reapproach 5%. And this has been the big driver of volatility, okay? However, what's not confirming, as the NASDAQ is making a new low, 10-year yield is not back at 5%. So you're not getting confirmation from that guy as well. All right, so where are we technically? Here we go. Here's the NASDAQ. I think we are in a complex. I've done a video before on this. If you guys remember the Back to School movie with Rodney Dangerfield, remember the triple Lindy at the top of the diving board? I kind of call the triple complex the triple Lindy here. So what it is basically it's like the PhD level corrections in Elliott wave world. It's basically 3 Elliott wave corrections connected by 2 X waves. All right, so specifically what it is it's ABC, connector X, ABC, connector X, and then another A, B, C. So there's some really interesting sort of kind of rhyming in here. There's some there's a lot of cool similarities within those 3 corrections. I'll show you right now. But basically, the outlook is this is still a corrective 4. We have anticipated support level right down here, as I'm mentioning, about 14,003 to 14,000. You have a rising 200-day moving average that is going to meet up with this support zone. And you have wave count and validation all the way down here at 12,080, right? So we have a long way to go. This is looking very, very corrective, okay? Now, what's cool about this triple Lindy complex is look at this. Check this out. This is a 97-minute chart, which is just a 1/4 day chart. Okay, look at how this thing's unfolding. Okay, down. So this is up to this is the July highs. So we go down, up, down. Okay, fine. There's your first ABC. Then we have connector X, and then what do we do again? Down, up, down. Another 3. Okay, and here's where it starts to break a little bit, but I still think it could be down, up, down. So basically what you're getting is 3 consecutive ABC corrections, which again is the dreaded triple Lindy PhD level Elliott wave correction, right? So it's ABC, X, ABC, X, ABC. Now, to further, I think, blow my mind is, okay, well, what's the distance of C on a fib projection compared to A? 200%. So whatever the percent distance traveled in A is, that is 3.4%. Put up a 6.8% decline, and that's going to be right here. Do a 200% projection of this A compared to C, that's the low. Do a 200% projection of this A compared to C, and we're right here at 14,405. So there's some really, really interesting sort of symmetry and rhyming and repeating, and there's a little bit of rhyme and reason here behind the triple correction, but I do see support down into that zone. And of course, it's going to be confirmed by the divergence in the internals I mentioned, 10-year yield holding 5%. I did a whole macro video this morning over on Inside Edge Capital. If you search Todd Gordon YouTube, talking about looking at yield curve, looking at real yield curve, how actually the real yield curve has gone positive. We're no longer inverted. There's a lot of reasons that I don't think the bottom is about to fall out. Now, we talked a lot about in the live stream this morning over on the other YouTube channel about bond vigilantes, which are remaining vigil on the the very chaotic political environment in the U.S. and our reckless spending, and markets are repricing how much the government's going to have to pay to borrow, and I think justifiably so, because it's a circus in Washington. So there's a supply of bonds, and if let me show you one more thing. I really didn't plan on doing this, but I'm kind of giving you more than I should. We try to reserve this for the members. If the bond market has, sold off as much as it's going to. Yields pushing up. This is a key zone of resistance of the 10-year yield from 5.17 to 5.45. Okay, think about that. What does that do? If the 10-year yield gets to 5.25, what other short-term rate is at 5.25? Fed funds. We have a flat yield curve now, right? And if you factor in expected inflation on the 10 to, it's no longer an inverted yield curve. It's not a bad thing. Everyone was saying recession, sell stocks because of inverted yield curve. Well, you don't have one anymore. And then you can come in and say the reason for it, which is a bear steepening, all that. Okay, but where am I wrong? I'm wrong if we break through 14K in the NASDAQ and we don't hold this 5.25, 5.5% 10-year yield and we start moving up to the next zone, which is 7. That's when, okay, I'm going to have to follow my sword and say I'm wrong. But, for now, I'm watching very, very closely. As I said, I'm so busy. I'm not even doing any public marketing. I'm just focusing on my members at Trading Analysis and my wealth management clients. Like, fine. I'm making less money by not marketing and pulling more people in, but I'm really taking care of, my members, and that should be our focus. And anybody who's running money and writing a research letter or doing that should probably spend less time marketing and more time in the markets. Anyways, we'll leave it there, guys. Have a good one, and I'll see you at some point on the next video update. Hi, it's Todd from TradingAnalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis, our fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at TradingAnalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.